Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here today for CPI. With us right now is my colleague, Allison Schrager. She's a senior fellow at the Manhattan Institute and a Bloomberg Opinion columnist. And hopefully, Catherine Rooney-Vera will be with us shortly. The expectation for today's number is that we're going to get a 0.2% print on month, which would translate into a 2.8% year-on-year figure. For core, the Wall Street consensus is looking for a 0.3%, which would translate into a 3%. The key issue this month, again, is going to be what happens with this tariff pass-through. But we'll also want to look under the hood and try and understand what's going on with underlying inflation, and if the case can still be made for rate cuts come September or maybe even a little later in the year. So, Allison, what do you think is going to be important today as we unpack these numbers?
Well, I mean, I don't think it's going to be an outrageous number, but I think what everyone's going to be scrutinizing is any sign that tariffs are impacting consumer goods. And this isn't just, I guess, so we can see what happens to what tariffs really mean for the economy. But I think it's super important for the Fed because, after some weak jobs numbers, there's certainly a lot of political pressure for them to cut. But if we start seeing the impact of tariffs on inflation, that's probably only going to get worse for the time being. And so that will put them in a much tougher position about whether or not they want to cut rates.
All right. Catherine, it looks like we have you there. Can you hear me all right?
Yes, John. Thank you for having me.
Wonderful. So what about you? What do you think will be most important as we scrutinize this number here?
I think that if we get a surprise to the upside or the downside, that's going to move markets probably in a meaningful fashion. Anything less than 0.3%, 0.25% will probably lead to full pricing in. We're already at 85% pricing in of a rate cut in September, but anything surprising to the downside of that would increase chances for even a 50 basis point cut in September. And then if you're looking at anything above 0.3%, 0.4%, I think it could potentially take September off the table. So that's what people, in my view, are looking at.
Okay. But supposing we do get inflation here, but we look under the hood and it seems like it's all about what's going on with tariffs. Aren't we supposed to look through those? Haven't we been told that we're supposed to see these as a one-time price level shift and sort of imagine that they're not there, Catherine?
Yeah, you're right about that. We have been told that they are using the term transitory. Potentially transitory. And the truth is they very well could be. But I think that this is a Fed reluctant to cut aggressively and doesn't want to cut aggressively. And really, there isn't any clear need to do so as yet. We are seeing a weakening labor market. But the Fed has kind of put itself in a tough position. I mean, having cut 50 basis points last year around this time and faced with a similar scenario in terms of inflation, you would think that they would be moving. So I think this puts them in a bit of a credibility challenge, depending on really the data that comes out in a few minutes' time.
Yeah. Allison, what do you think about the balancing of the two goal variables here? And I may cut you off as the numbers come out here. Obviously, we got a weak jobs report recently. Does that change the calculus here?
Certainly. I mean, I think before that jobs report, there's really no justification for cutting rates because it didn't seem like higher rates were having any contractionary impact on the economy. So now now monetary policy is honestly getting the most interesting it has probably in all of our professional lifetimes because there are actually real trade-offs now in a way. I mean, there honestly hasn't been since, in decades.
Right. All right. Well, in just a few moments' time, we're going to bring you this number as it comes in. Okay, so here we go. Let's just give it a few seconds. So we get a 0.2 on headline, a 0.3 on core. The year-on-year translation for headline actually comes in a little bit soft, 2.7 versus the survey, but the year-on-year on core actually rounds up versus the survey, 3.1%. The expectation has been 3. But the key thing I think to focus on here is that these month-on-month seasonally adjusted figures come in bang on, exactly as the street had been expecting. I'll give you a quick market reaction here. Take you over to the yield on the 2-year Treasury note. Let's see what's happening over there. So you see an initial sharp drop in the yield on the 2-year Treasury note off of the back of this number. You see it moving down to a 3.72%. We were hovering around 3.77% coming into this. Catherine Rooney Vera, your first reaction to this figure here?
I think that this gives the Fed space to cut in September. I really do. I think it tells us that the consumer is probably too potentially weak at this point to absorb too much pricing power. Firms are not passing on the costs of tariffs. We would have thought, and this is something that, John, we were thinking in StoneX, that the impact of tariffs would start to be felt in this number and in the month of August. Now, we still have August, we still have CPI for August, we still have non-farm payrolls before the September meeting, and those data are also going to be very important. But I think the combination of a weaker labor market from last month and this inflation print that's basically spot on with consensus, it is in line with what we at StoneX had forecasted ourselves, and the consensus, I think, could open the Fed up to a 25 basis point cut without losing face, because I think the data align with that. It's yet to be seen, however, especially because of the staggered nature of tariffs and the on-again, off-again way it's been handled, whether or not we're going to eventually see the impact of tariffs. John, you and I have talked about, we've seen some impact in apparel and other areas, but whether or not that's going to cause a more meaningful lift in goods inflation is yet to be determined.
Yeah, let me just take you through some numbers real quick. So here are your seasonally adjusted changes from the previous month from the BLS website. So again, core comes in at 0.3. You get new vehicles flat. Used cars and trucks do see a meaningful move up. There's some thinking that this is related to tariffs, even though, generally speaking, you're not importing these cars. But if you affect the supply of new cars, it's going to affect the prices of used cars as well. So used cars and trucks step up. Apparel, we see a 0.1% move month on month. That's a moderation from last month's 0.4%. So perhaps a slight moderation of any tariff-related effects there in apparel. Just real quickly, shelter is another 0.2%. Transportation services that can be affected by things like auto insurance, fairly strong move there, 0.8% month on month, and also a 0.8% month on month in medical care services. The one thing that I just want to underscore is that when you look at some of these elements, transportation services, medical care services, they're part of what we have traditionally called the super core. These things should be completely unrelated to tariffs. And, it's just one month on month seasonally adjusted figure. But if your argument is going to be that if you strip away tariffs, there's no inflation, or we're close to the 2% goal, maybe what we're seeing here in transportation services and medical care services gives you a little bit of pause here for this number. So let's see. Allison, let me bring you back in here along those lines of this case that I'm laying out here. So Governor Waller, right? He's a guy to watch right now, right? Because people think that he is a favorite to be the next chair. He dissented recently. He's one of, if not the most dovish voices on the committee right now. And what he says is that if you strip out the tariff effects, we actually are relatively close to the Fed's 2% target. So, two questions for you, Allison. Is that the right way to think about inflation right now? And given what we were just talking about in transportation services, medical care services, does this report seem consistent with that Waller view?
I mean, he should know better. I mean, we just had this whole experience of inflation in 2021, and everyone was like, oh, it's just this. So the rest doesn't matter. Prices don't work that way. It's like you have consumers, if the price of something goes up, they switch to something else. It's the overall price level that matters. And you can't just say, oh, it's transitory, because that impacts expectations, which impacts a larger inflation. I think we've already learned the Fed has a lot of motivated reasoning to sort of call inflation something it's not. Like inflation's still high, and they just have to accept the fact that, gee, maybe their 2% target is no longer realistic. And if they want to start cutting rates and getting more focused on the labor market, they kind of just have to accept defeat on 2% and maybe in their framework review start thinking about a different target.
Okay, Catherine, what do you think about this notion of going back to custom indices? On this very call, I have often fallen into the trap of anchoring to a custom index. Let's carve out shelter, or let's carve out used cars. And here we have a Fed governor, Christopher Waller, sort of advocating for, maybe we should be focusing on inflation X all of these tariff related things. Is that the right way to be thinking about inflation right now? Or do you agree with Allison that you really need to be looking at the all in number here?
There's a time and a place, and I don't think you want to change or customize the target when when inflation is above the current target. So that, I think, would be a huge hit to credibility. So ideally, those conversations are being had, and seemingly they are, John, in terms of either a custom target or an increase in the target, inflation number. Deglobalization, changing of supply chains, a new economic reality probably mean that inflation is structurally higher. So those conversations should and hopefully are being had. I just don't think that you want to talk too publicly about that when inflation is still kind of far from the 2% average target at the moment. So that's what I would be wary of, especially with a Fed that's grappling to some extent with inflation fighting credibility and potentially risking a policy error here. I mean, if they are going for a 2% target in a structurally higher inflationary world, at least in the United States, I should say, then you risk the other side of the mandate and keeping rates too high for too long. We're already seeing, John, delinquencies move higher in autos and credit cards. Of course, student loans is a different story, but that's jumped because the end of the moratorium. But I think what you would see the market react to is a pretty swift repricing were the Fed to change its target in any way. Recently they did change it to average, and there was kind of like a yawning in the markets. But I think if we were to move to a custom target, would be a different story. Today we're just looking at front end rally. We've seen the cut odds for September. Seems like the market is expecting a surefire bet. September happens. Bull steepening is happening at the moment. I think you're probably going to see relief today for interest rate sensitive sectors, housing, small caps, tech bids should continue, dollar should weaken. I do expect gold to be up, yields down, inflation hedges kind of pause. I think the markets are going to cheer a September cut, but everybody's focused on two things. I think the labor market and really how far Powell is going to go, and of course who succeeds Powell. But yeah, I think, look, at the end of the day, the labor market is weakening, but I kind of agree with something Allison said, which is, you know, we're not at the point where the Fed has to rush a huge cut. And I don't think this inflation data point nor last month's labor market lend to a 50 basis point super cut, which some people are postulating now. Probably they'll go with 25 in September. I don't know, Allison, if you agree, if you think this is enough
No.
for them to cut September.
The thing is, if they're cutting rates, they're giving up on the target. Like they can say, oh yeah, we still have this pie in the sky target. But I mean, and to be fair, since they've had the 2% target, they've never made it. Like I'm starting to I was weaned on inflation targeting, you know, I was learned monetary policy from Rick Michigan. But I'm just starting to think, you know, they and I'm not saying this was even bad monetary policy. I'm just thinking inflation targeting might just not be a good policy. Like they've never been able to make it. It's always bad for their credibility. And they can say, yeah, someday we'll get to 2%, but for now we're cutting rates. And
so what should they target, Allison? Nominal growth?
What? No, I mean, you know, they should just go to a more rules-based framework rather than saying to target something they can do. I think honestly, NGDP targeting is even worse. They have even less control over that. Like now all of a sudden there's something in their objective function that like they can't even control. So really, they should just go back to rules-based policy. I always felt like inflation targeting was them trying to have their cake and eat it too anyway. That forward guidance. It's sort of like, well, we want discretion, but we want the credibility of rules. So we have this sort of rule we can't really do that's sort of abstract. So we can just do discretion in the meantime. It's like, you know, they should all know better. They should just accept they can't make any of these sort of macro variables and just go back to something simpler, more rules oriented, or just say, hey, we're doing discretion and we have no credibility. And honestly, they could probably live with that too.
But wait a minute. Possible, maybe even likely future Fed chair, Christopher Waller says, you know, we're at 4.25 to 4.55%. Like what do we think trend inflation is? 3%? We're tight. We can still cut one or two times and be relatively restrictive, can't we? Isn't one or two cuts still consistent with my goal is 2% and I think we can cut and still get there?
Are we tight?
I mean, you know, I will admit it's getting more and more confusing, right? The labor market says we're kind of tight, doesn't it? The stock market does not. The stock market does not agree with me on that.
And real rates are very high as well, right? So, I mean, it is debatable as to whether or not we're tight, but goodness, at 4.25% with real rates at about 2%, I think the longer we keep rates this high, the more we risk downslide in the economy, especially when we're looking at a few leading indicators such as delinquency numbers and a softening in the labor market. If people lose their jobs or fear they're going to lose their jobs, and at the same time are paying sky high rates or can't get a loan, because the fact is that banks start to tighten lending standards when they get spooked. And so if the labor market even has the blush of rolling over, banks tighten lending standards. So you get this combo of guys can't get loans. And if they can get a loan, it's very expensive. The loans that they have on their books are costing them a fortune. And they're potentially losing their jobs as the labor market rolls over. That's a recipe, in my view, for disaster. So I think the Fed needs to, probably should get going here. That's my view. I think the Fed needs to get going. I think that a big risk here, John, and this is behavioral economics. This is just me hypothesizing here, but it kind of reminds me of, rebellious teenagers when somebody says, you're misguided, you need to do this. And the natural response is to do the opposite. So if the president is belittling the Federal Reserve, almost making fun of them, publicly humiliating them, I think then that the natural response is to say, you know what, not doing it. I'll do it when I think it's the right time. So I'm a little concerned that they wait too long. And then we see this more meaningful slide in the labor market, and you see delinquencies move higher. Things are softening. Yesterday I was just on with Bloomberg TV, John. I saw you in the office, and the first question that I got asked was, is this stagflation or is this a soft landing? So now we're back to the recession thing. So people are talking about the risk of recession. Are we in a stagflationary scenario? The truth is, we just printed a 3% number. The IMF this past week just increased US GDP forecast to 1.9%. The truth is that the trade deals are coming through. We can argue if they're good or not, but they're coming through. The Treasury coffers are at a run rate of $300 billion in new revenues from tariffs. So I think while they have the space, they should probably get this thing going. That's my view.
So, I mean, when you say people can't get loans, you mean which kind of loans? Like consumer loans, car loans, mortgages, or small business loans? Like who goes to banks for loans?
Well, when I talk about tightening of lending standards, it means that the banks put more restrictions on lending. It's not as easy to take out a loan. So that's historically what you see, a tightening of lending standards ahead of an economic downturn. So that's one of the leading indicators that I look at, Allison, with recession leading
But like I
indicators.
said, bank loans are becoming such a smaller share of overall lending. So I'm just curious. I honestly don't know. So when I understand like the lending standards, but to who, for what kind of loans?
Well, credit card, you have credit card loans, you have auto loans, you have home loans, you have student loans. So the point here is that we're all indebted. We're an indebted nation. So the
Yeah,
loans that we
but
have to service, the interest rates are high. And so when interest rates are high and the labor market starts to roll over, it becomes more costly to finance those loans. And so what people do is they delay payment on the loans. And
yeah,
that's effectively what we're
I
seeing.
understand that. It's just pushing back a bit on maybe an argument for why they're not just being petulant teenagers here, is, there's different parts of the yield curve that impact different parts of these loans. But say, for instance, mortgages, it's on the 10-year. So suppose that it looks like the Fed, and I mean, honestly, we don't know, we're just playing mind games, is that the Fed seems like they're rolling over on political pressure. That increases inflation expectations. That also increases the term premium. So that could impact the 10-year, which impacts mortgages. So I think it's just like, I think these old relationships that we were thinking about with interest rates and how they impact households or different parts, it's just getting a little bit more complicated than it used to be.
I would probably push back a little. I'm a bit more of a conservative economist. I tend to think that we are moving into this realm, Allison, and I feel this in my world of economists, that we're like chucking, economic 101 realities out the window, and everything is new and everything's different. I tend to think that's not the case, and I think that at the end of the day, we are in a behavioral economics world where if people feel good, they consume.
Mhm.
And the main driver is the consumption of services. If people have jobs, if rates are low, they're taking out loans. Of course, the 10-year, the mortgages are attached to the 10-year. But the truth is that people are heavily indebted. So I think that if we're going to expect things to shake out and then get this soft landing, we want to kind of save the consumer, and the consumer continues to consume. It's just that now they're delaying payments on their loans, on their debts. So
Well, should we though? I mean, like, I understand to save the economy, but if you're saying consumers are heavily indebted, and so we should keep rates lower so they should get more indebted, I feel like, I mean, I guess that would stave off or any stagflation, but like it seems like that's not necessarily a healthy way to run an economy either.
Well, how about this though, Allison? I mean, we all know what the goal variables are, right? Stable prices and maximum employment.
And financial
Are,
stability. I mean, like third, like lesser. So
right, but the FOMC has two goal variables, and presumably the case for cutting here is all about concerns about the labor market.
Mhm.
Is it your contention that if they cut here, it wouldn't do anything to help the labor market?
No, I mean, it could, in the sense that people are like, oh, the Fed is on it. And I think that makes people feel more optimistic. I mean, it's sort of more of a sugar high. But I think what's going on in the labor market might be a little bit more structural. And in which case, I'm not sure even a 50 basis point rate cut's really going to make a huge difference. I think the labor market was really, really hot coming out of the pandemic, and it's sort of equilibrating to something else. I mean, on the margin, maybe a rate cut will do something, but I'm not sure it's really going to, make up for the big structural changes that are happening.
Right. Another thing that I sort of worry about. I mean, I don't mean to make light of some of the concerning things in the labor market. That last report really was a head scratcher. But what we don't see is major upward momentum in the unemployment rate, nor do we see an alarming jump in something like layoffs that is manifesting itself in claims. It seems to be a sort of a no hire, no fire labor market. And I don't actually see anywhere in the Fed's dual mandate where they are supposed to encourage greater churn in the labor market. It's maximum employment. So is the fact that we've kind of ground to a halt reason enough to spur them into action? What do you think, Catherine?
I'm sorry, John. I'll have to pass it to Allison because I couldn't quite hear what you said.
Okay, Allison, you want to jump in here? The question is, it's not the problem doesn't seem to be at this moment maximum employment, because the unemployment rate, on all accounts, still looks really, really good. The problem in this labor market is there's no churn. People on the outside can't get in. So is that consistent with an environment in which the Fed should be taking action? Allison,
I hear you. Okay.
I'll go ahead. I'll start the conversation. You jump in at any time. Feel free to interrupt me too. Yeah, I mean, I think churn is actually an important part of a healthy labor market. It's not only important in terms of young graduates getting their foot in the door, but it also is important for individuals so they can move to a better paying job. I mean, changing jobs is largely where people get pay increases. And so I think, a labor market where everything's frozen, it's like a housing market where everything's frozen. Like, it's not a good situation. So, I mean, to the extent that, and this is debatable whether or not a rate cut could help churn, I think a frozen labor market is potentially worrying. And as I said, it's not an explicit part of the mandate because they just look at unemployment, but it's definitely something people should be concerned about.
I think that's in lockstep with the need to cut rates, actually, because you're seeing people being locked out of not just the labor market, but we have a phenomenon called the crowding out of the private sector. And that's what's occurring now because rates are so high. So you have people locked out of the housing market. You have people locked out of affordability. And so the way to do that is to conform to economic standards and, in my view, cut rates. Why? Because when you have a crowding out and locking people out, you risk disillusionment, you risk defaults, you risk a rollover of consumption, which is 2/3 of the US economy, and ultimately you risk recession. So that's where I'm concerned. And I think that the crowding out of the private sector is something that I really don't hear anyone else talking about, but I talk about it quite a bit. And that is, I can see it on a micro and macro level. I can see it on a micro level with people not being able to afford houses. And I can see it on a macro level because of the inordinate use of short-term financing pushing rates higher and higher. And so that affects the common man because things get less affordable, and it affects corporations. It affects the private sector because the public and the private sector vie for the same pool of capital. So what happens here is that the government is absorbing so much of that capital that it pushes rates higher, causing potential growth for the economy to slow. And we're seeing something similar. John, I know you look at emerging markets, but I find this a fascinating environment because in Argentina, they've followed such excellent economic policy and they've collapsed the fiscal deficit and reduced the necessity of the government to indebт itself and to issue paper, such that it's caused the crowding in of the private sector. And you have corporations now, for the first time since the default 25 years ago, issuing in the market. So I do think we need to correct, and I'm hopeful that there are no policy errors, and I think that we could be at the start of a significant easing cycle. I don't think this year it really matters if we get 25 or 50 or 75. I'm more looking to 2026 and seeing if, in fact, the Fed goes 100, 150 basis points.
Mm. All right. Listen, we need to start wrapping up here. I can't believe we didn't even have time to talk about EJ and Tony for BLS. It goes so fast with you guys. But I do want to stay coherent here and wrap things up by asking both of you. So we're going to get another CPI before the next Fed decision, and we're also going to get another round of jobs data, right? So by no means is our interpretation of today's data definitive for what's going to happen in monetary policy. My question to you, Allison, first is, what do you think needs to happen in the August data that comes out in early September for us to see a cut in September from the Federal Reserve?
The CPI or jobs?
I mean, give them both to me, because we're gonna get both before the Fed is up to bat here.
Honestly, I think they're inclined to cut, so probably just more of the same.
More of the same.
I think they're looking for an excuse to cut. So as long as inflation doesn't spike up well above, I think Catherine's right. As long as it's not too much above, and unless like we see a rip roaring jobs report, like I think it's pretty much where we are is enough for them.
But you personally, as Fed Governor Allison Schrager, you would not cut in September?
I'm more hawkish than most people on the Fed board. I mean, that's my orientation. But they're a lot more dovish than I am, and they're in charge. So,
all right. And Catherine Rooney Vera, what it sounds like you're leaning towards cuts. What needs to happen between now and September to firm that up so that we absolutely get that cut?
Well, we have another CPI and we have non-farm. So non-farm below the level of new entrants, which maintains the labor market, I think would firm up a cut. So that's anything, non-farm below 150, 170, I think firms up a cut. And then CPI, I think in the range of, similar to what we had today, 0.2, 0.3%, I think affirms the Fed September ease. So those two things, those are the specific numbers that I'm looking at for the Fed to cut in September.
All right. Well, I want to thank everybody for tuning in. Thank you to Catherine Rooney Vera. Thank you to Allison Schrager. Your CPI month on month for the month of July came in at 0.2%. It's a 0.3%, but the market is happy with meeting consensus. So there you have it. We'll see you again for the next one.
Thanks, John. Thanks, Allison.